Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The USDA report from last week was bearish, pushing the markets down to support. As we can see here in the May corn contract, the move that we're looking at currently sits at volatility-based support. Additionally, we can see our sinusoidal wave trend line also has caused a nice little pause in the move to the downside. In the event that this pause does hold, we look for the market to stay stable at least 5 to 7 trading bars over the next few days, with the potential of moving up against this sinusoidal wave and moving potentially as high as resistance at 373.5. The collapse that we saw is consistent with our expectations, especially after the market hit up against very good strong resistance overhead. And once the market was able to reverse off of this area and break down through that 373 3/4 area, which is our 360-degree mark, the market then precipitously fell down into where we have potential support. We also shared about how once the market was able to break out of this tunnel in which it was trading inside of this range here, upon breaking this range, which it did about a week ago, you can see here, we can see a very clean break, and at which point the market was able to pick up and start to trend along this 1x2 angle on its way down. We currently sit at potential support, as mentioned earlier, near this 360 to 364 area, and this is going to be very critical for this market. And if it's able to make a bounce up, once again, near that 373 area is perhaps where we look to find very good resistance before the market may very well make its way back down again. In doing so, we're looking for the market to either hit up against resistance and perhaps trade a bit sideways with the potential of maybe making a small marginal new low into the end of the month and perhaps finding a bottom near early April before it can start to potentially trend back up again. We have the exact same formation here in the July contract with the exception of the different levels showing, so we at least wanted to share those levels with you. We have key support sitting at about 368. With key resistance overhead coming in just beyond that 375 mark for this contract where the 360-degree mark lives. Upon being able to break through there, right in the middle of that area or in the middle of that zone in an intermediate fashion, we'd be looking at about 382 as potential resistance in the event that this market's actually able to make its way above the 375 mark. That 380 mark can best be seen right up against this trend line here, where we find very good resistance if this market in fact is able to make its way up before potentially turning back down again. If it's actually able to get to this 380 mark and stay above, then we can actually see a little bit of strength to the upside, but in all likelihood on this first push, we should probably see a little bit of selling occur near this area and then trending back down a bit before turning up again. The main operating levels for the December contract sit at 392.5 as well as 382 3/4. And so inside of this region or inside of this band is where we would look for the market to actually make its move up and down for potential support and resistance. Again, above this 335-degree mark, look for continued strength. But upon breaking this 382 3/4 number, find some more marginal weakness to the downside. But once again, like the other contracts, the market has actually shifted up its band. And so as you can see here, a new band will probably create itself upwards, suggesting that we have exhaustion in these corn markets and that this could very well be a reasonable low that stands for some time. For the soybean contracts, we shared how the successive consecutive lower highs and lower lows was a clear indication that potential weakness was setting in and that the market was due for a good collapse to the downside. As you can see from the charts here, the market did in fact fall from these levels, especially after having hit this 1050 number, the market found very good resistance. Like the corn contract, we have fallen into volatility-based support. And also we want to bring to your attention the minimum price objective that we talked about before of 996.5 having been hit, with the potential of reaching 986, but right now in today's market or in today's move, we can see a bit of a bounce for this soybean contract, which is not uncommon after having fallen for about the last 7 to 12 trading days. 996.5 should operate as a very key level for this contract, with overhead potential resistance sitting at 1018, and in the event that the market comes back down and breaks this 996.5 number, look for a potential target in the neighborhood of 975.5. It should come as no surprise how our time price tool has been giving us very important key support and resistance areas for this contract as the market has touched those zones. We have resistance overhead here. We've had support as he's touched the 1x1 down angle. Right here on a quartile area, we saw good resistance. And again, it was, as we can see today and yesterday, the market came in and is making reasonable support up against 50% of the range of the captured movement from prior timelines. From here, we would look to see whether or not the market's able to get some legs and then come up to potential resistance, or otherwise just simply consolidate a little bit inside of the area where it lives here, where it could very well break back down again. The same formation was present for the July soybean contract. We can see the consecutive lower highs as well as lower lows that were posted. And for this market here, one thing that would be telltale is in the event that the market comes up and makes another lower high and then breaks this previous low, that could be very dangerous for this market. That would give us our fourth consecutive lower high and fourth consecutive lower low. And when this happens, you can expect a pretty fast move to the downside in a break of a market like this. This would be the last exhaustive move in this leg itself. Looking for it to touch somewhere in the neighborhood of 985.5, and below that we could even see a move potentially going as low as about 970. For now, depending on how the market operates around this 1015 number will determine whether or not it's able to actually come back down. Look for strength above 1015, but continued weakness below 1015. That could very well touch this 983.5 number. Unlike its counterparts, the November contract was not as weak. As mentioned in previous sessions, we talked about the triple top that was formed here, but that was in conjunction with consecutive higher lows, unlike the other two contracts. It finally broke this previous low here, but the low that we're seeing is simply testing what we saw back in early January. And so that being the case, if this market's able to recover here, in all likelihood, resistance, or rather support, should rest somewhere in the neighborhood of 980, and there's a very good chance the market may not get much lower than this 980 number, retesting previous lows, and then simply moving sideways before it's able to make its way back up again in early April. Wheat futures also fell prey to the sell-off last week. And as we can see evidenced here, after a very nice drop in early February, the market again made a lower high, and we see another drop, and the market came very close to that one-to-one correspondence that we spoke about last time. We had a target roughly in the neighborhood of 441, 440.75. This contract got very close to that target, making a low at 443.5. As we can see right at this number here, we had a couple key objectives that the market could have made. In the event that one took that short with the stop above that previous high and going in short just below the break of that high bar, what you would find is about a one-to-one correspondence in terms of risk reward coming in at 475 and a 2-to-1 risk reward factor at 446. So this market did make a 2-to-1 risk reward move given this potential trade that did establish itself about a week and a half ago. And this is a good spot, obviously, to look for covering, or at the very least, adjusting stops from being above the market to below wherever your entry was, and even potentially bringing it down to about that one-to-one level to lock in potential profits as best as possible. Down below, we see volatility-based support setting up near that 441 mark. And so as the market has come in, we saw a bit of exhaustion coming in with this big move to the downside. And as would be expected, we can see a small bounce here and a bit of consolidation. A couple key levels on the horizon for this contract would be overhead at 462, and then downside potential support obviously coming in at 441. Our expectation is for continued downside pressure, so upon making a move up to about that 460 to 462 area, if it's even able to make it up to that zone, we would be looking for the market to come in and actually break to make even greater lows, looking to touch somewhere in the neighborhood of 420 to 425. Here we find a similar pattern for the December contract. It too is just shy of support at 475.5, at 474.5. Bouncing up from this area, overhead resistance here at 485.5. We can see a marginal break where the previous low could very well serve as good resistance, and in turn causing this market to look to move back down again. We have volatility-based support coming in the neighborhood of 475 to 464. But breaking below there, we have our next bands coming in well below the market, which would indicate a potential move to 450 over the coming months. In closing, the big downside move in crude oil that we were looking for has finally come to fruition. And we can see a potential short-term low coming in right inside of the time factors that we had spoken about. We see a very big move to the downside. We would have had our stop above the market at about 54.70. Entry near that 53 number that we talked about before, call it 53.5. And a break of this market here shows where the downside push occurred, giving us a move that was almost a 5-to-1 risk-reward factor. The market did touch a 4.5-to-1 risk reward. So in the event that you did take this trade upon that break near 53 that we've been discussing, that would have presumably been a very profitable trade for you. We continue to see potential weakness here in crude, but for now we should expect a short-term bounce. The overhead resistance could very well sit at about 51.25, but we don't see any narrative that points to the market really being able to garner much strength from here. Recent reports show that Saudi Arabia is going to increase some of its output that it had previously promised that it would have been reducing. So again, we see continued pressure potentially for crude oil to the downside and for continued opportunities for potential shorts on bounces. Thank you so much for joining us for our weekly market update. Look forward to touching base with you again next week.